If you're watching the metals market today, you probably felt that jolt. Because something just happened in silver that almost never happens. I'm talking about a record rebound after a historic crash. Silver didn't just bounce, it exploded higher, ripping nearly 10% in a single session after one of the ugliest two-day sell-offs modern traders have seen. That kind of whiplash isn't noise, it's information. And stay with me, because I'm going to show you what this move is really signaling, not just about silver, but about how forced liquidation cycles work, so you can recognize them before the crowd does next time. Before I explain what caused this, let me teach you something most people misunderstand about markets. Prices don't fall or rise because investors suddenly become smarter or dumber overnight. Markets are machines, mechanical, structured. When pressure builds inside that machine, eventually something snaps. Think of it like a crowded theater where someone yells, "Fire." At first, a few people rush the exit. Then more panic. Suddenly, everyone's trying to squeeze through the same door at once. That's not a calm decision. That's physics. Liquidity disappears, bids vanish, and prices gap lower until the selling exhausts itself. Here's what you need to know. Extreme drops often plant the seeds for extreme rebounds. Why? Because markets overshoot in both directions. Fear pushes prices too low, just like euphoria pushes them too high. So when you see a collapse followed by stabilization, smart money starts asking a simple question. Did price fall further than the underlying reality justified? If this is making sense so far, drop a comment and let me know you're following along. I want to make sure I'm explaining this clearly. Now here's what's actually happening beneath the surface. Last week's crash wasn't just emotional selling. The primary driver was forced liquidation, triggered by higher futures margin requirements. When exchanges raise margins, traders suddenly need more cash to hold the same positions. If they can't post it, their positions get cut, automatically. Let me break down the sequence for you. Silver starts falling. Leveraged traders take losses. Margin requirements jump. Brokers issue margin calls. Traders sell whatever they can, sometimes even profitable positions just to survive. That selling causes more price declines, which triggers more margin calls. It's a cascade, a chain reaction that feeds on itself. And here's the critical part. Once that cascade starts, fundamentals don't matter anymore. Value doesn't matter. The only thing that matters is who needs cash right now and what they're willing to sell to get it. You could have the best analysis in the world about where silver should be trading, but when a margin clerk calls you at 7 in the morning demanding $50,000 by noon, your thesis becomes irrelevant. The secondary confirmation came from the speed of the drop. A 27% single-session collapse isn't orderly distribution. It screams mechanical unwinding. Institutions don't sell like that. Long-term holders don't sell like that. That's the signature of forced liquidation. Then Monday extended the damage, pushing the market into territory technicians call extreme oversold, a zone where historically sellers begin to run out of ammunition. Now I want you to understand something else that was happening simultaneously. While silver was collapsing, volatility was spiking. And when volatility spikes, risk models automatically reduce position sizes. So you had margin calls forcing sales, and you had algorithmic systems cutting exposure because their volatility targets got breached. Two mechanical systems operating at the same time, both pushing in the same direction. Selling, feeding, selling. But here's the part that should make you nervous. Reflex rallies can look incredibly convincing. Some of the strongest up days in history happened inside broader volatile regimes. So the question you should be asking isn't, is silver back? The better question is, was that the liquidation reset, or just the first tremor before another move? Here's what's wild about today's surge. It doesn't necessarily mean investors suddenly turned bullish. It likely means the forced sellers are mostly gone. And when the marginal seller disappears, price can jump violently because there's no longer constant supply hitting the market. Think about that. The same mechanical pressure that drove it down creates the conditions for it to snap back up. Not because fundamentals changed, because the selling pressure that was artificial finally exhausted itself. This is the exact same playbook markets have run before. Think back to the 2020 pandemic shock. Metals plunged as funds scrambled for cash, only to roar back once forced selling cleared. I remember watching gold drop below $1,500 in March when everyone needed dollars immediately. Then, within months, it was pushing past 2,000. Same pattern. Or go back to the 2008 financial crisis. Gold initially dropped during the liquidity panic before launching into a multi-year climb. Why? Because in the panic phase, people weren't selling what they wanted to sell. They were selling what they could sell. The most liquid assets went first. Then, once that pressure released, capital flowed back to where people actually wanted to be positioned. Even the 2011 silver spike had brutal shakeouts that ejected late leverage before the next surge. Silver hit nearly $50, then crashed to $33 in a matter of days. People thought the rally was over, but that washout cleaned out the weak hands, and silver spent months building another base. When you look at the pattern, you see something consistent. Leverage builds quietly. Stress enters the system. Liquidation wipes the board. Then the market decides its real direction afterward. Every single time. Zoom out and the larger story becomes clearer. These events aren't random. They're structural pressure releases inside leveraged ecosystems. And once you understand that, you stop reacting emotionally and start watching mechanically. Now let me be skeptical for a moment, because I want you to hear independent thinking, not just hype. Could this bounce fail? Absolutely. Sometimes what looks like dip buying is just short covering, traders buying back positions to lock profits rather than expressing long-term conviction. That can create a powerful but temporary surge. Could there be another leg down? Yes. If the conditions that caused the first cascade are still present, nothing stops a second wave from hitting. Maybe more margin requirements get raised. Maybe another asset class breaks and creates contagion. We don't know. And here's the thing about manipulation claims you'll hear floating around. Markets don't need conspiracies to crash. Leverage alone is enough. You don't need some shadowy group pushing buttons when you've got automated margin systems and volatility algorithms all responding to the same inputs. Focus on what you can actually observe. Margin changes, volatility spikes, liquidity conditions. Those are measurable. Those are real. There are probably 3 types of people watching this right now. First, some of you sold into the panic. Maybe you protected capital. Maybe you feel frustrated watching the rebound. Let me be honest with you. Survival is a strategy. If you stayed solvent, you kept optionality. Your job now isn't regret, it's discipline. Wait for structure before chasing. If this rally's real, you'll get another entry. If it's not, you'll be glad you waited. Second, some of you bought the dip. You stepped in when it felt uncomfortable. That takes nerve. I respect that. But remember, great entries still require risk management. Ask yourself, if this rally retraces, where's your exit? Hope is not a plan. Define your risk now while you're thinking clearly, not later when emotions running high. Third, some of you wisely did nothing. And don't underestimate that. Sitting out chaos is often the professional move. Cash is a position. Patience is an edge. The traders who survive long-term aren't the ones who catch every move. They're the ones who avoid the big mistakes. The universal principle here? Don't react to headlines. React to mechanics. Headlines tell you what happened. Mechanics tell you why it happened and what might happen next. So here's what I want you to answer in the comments. Which type are you? Did you sell? Did you buy? Or did you hold? And more importantly, what's your plan from here? I'm genuinely curious how you're thinking about this. Here's where I stand personally. I'm not calling this a new bull run, and I'm not dismissing it either. I'm watching. Carefully. Let me tell you what I'm looking at over the next few sessions. First, I'm watching whether follow-through buying appears. Does silver hold these gains and build on them, or does it fade back as profit-taking hits? That'll tell us if real conviction's entering the market, or if this was just a mechanical bounce. Second, I'm watching volatility. Does it compress or expand again? If volatility starts settling down, that suggests the system's stabilizing. If it stays elevated or spikes again, that tells me we're still in the danger zone and another shakeout's possible. Third, I'm monitoring margin policy. Because if exchanges tighten conditions again, that could reignite pressure fast. Margin requirements are like the circuit breakers in the system. When they get flipped, forced selling can resume even if sentiment's improving. And I'm also keeping an eye on correlations. Is silver moving independently, or is it still tracking broader risk assets? If it's moving on its own logic, that's one thing. If it's just bouncing because stocks are bouncing, that's a different setup entirely. Based on my analysis, this crash and rebound was mechanical, not random. It was driven by leverage unwinding and margin pressure, not a fundamental reassessment of silver's value. The underlying macro story hasn't rewritten itself overnight. You've still got the same monetary conditions. You've still got the same supply and demand fundamentals. You've still got the same geopolitical backdrop. None of that changed between Friday and today. What changed was the technical structure. The market got cleared of forced sellers. That's significant, but it's not the same as a fundamental shift in the narrative. If history rhymes and silver consolidates here rather than immediately collapsing again, the move that follows could be substantial, because you'd have a clean technical base with weak hands already shaken out. But that's an if. And I'm not making predictions, I'm mapping scenarios. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I'm saying. Don't take my word for anything. Your capital, your decisions, your responsibility. If you made it this far, you're thinking like a market participant, not a spectator. That mentality will serve you well. The people who survive and thrive in volatile markets aren't the ones who panic or chase. They're the ones who understand the mechanics and wait for their setup. If this breakdown helped you understand what's really happening, share this video with someone who needs to see it. Subscribe if you want more analysis like this. And drop your thoughts in the comments because I read every single one. Stay sharp out there. Think critically, verify the data, and make your own decisions.